In the third quarter of 2025, BlackRock quietly transferred $2.1 trillion in assets from U.S. domiciled funds to international jurisdictions. Not moved, transferred. Legal domicile changes for over 40% of BlackRock's total assets under management. The transfers occurred through technical restructuring that avoided SEC disclosure requirements. Dublin domiciled funds increased by $847 billion. Luxembourg entities expanded by $623 billion. Singapore operations grew by $441 billion. Hong Kong structures added $289 billion. This was not portfolio rebalancing. This was not geographic diversification. This was systematic preparation for American financial system breakdown, when the world's largest asset manager removes $2.1 trillion from American legal jurisdiction, when the institution that manages more money than most nations' GDP quietly repositions outside American oversight, when BlackRock's internal risk models trigger capital preservation protocols. The signal is unmistakable. BlackRock processes more financial data than any institution in human history. Their Aladdin risk management system monitors $21 trillion in global assets. They analyze government debt sustainability, currency stability risks, and systemic collapse probabilities for institutional clients worldwide. BlackRock knows something that public markets do not yet recognize. Their $2.1 trillion transfer represents institutional recognition that American financial stability is approaching mathematical limits. This is not speculation. This is the largest capital preservation action in modern financial history. The frame, the pattern. Throughout recorded history, empire collapse follows the same sequence of capital flight patterns. The process begins with institutional recognition of systemic risks that are not yet visible to general populations. First, the largest financial institutions quietly begin repositioning assets away from the imperial center, not selling investments, not reducing exposure, relocating legal structures and operational control to jurisdictions outside the failing empire's direct authority. Second, wealthy families and private capital begin systematic geographic diversification, not panic moves, not obvious exits. Gradual establishment of alternative residence, business structures, and asset holdings in multiple jurisdictions. Third, foreign institutional capital reduces exposure to imperial assets. Central banks decrease reserve holdings. Sovereign wealth funds reallocate investments. International pension funds reduce positions in imperial government bonds and imperial corporate securities. Fourth, domestic institutional capital begins following international patterns. Domestic banks reduce government bond holdings. Domestic insurance companies diversify internationally. Domestic pension funds increase foreign allocations beyond normal diversification levels. Fifth, the general population begins recognizing the pattern. Capital controls are often implemented at this stage to prevent mass exodus. Exit taxes, currency restrictions, and asset confiscation measures typically accelerate rather than prevent capital flight. Sixth, the remaining capital becomes trapped within the imperial system. Currency devaluation, hyperinflation, or system collapse destroys the value of assets that could not be relocated. Wealth concentration shifts from trapped domestic assets to relocated international assets. This pattern has repeated with mechanical precision across every major empire collapse in recorded history. The timing varies. The specific mechanisms differ. The sequence remains identical. The current BlackRock transfer represents stage one of this historical pattern. Institutional recognition and systematic repositioning before general awareness develops. The historical machine Rome, 376 to 476 AD, the decline of the Western Roman Empire followed this capital flight pattern exactly. Archaeological evidence and historical records document systematic wealth migration from Roman territories to Constantinople, Germanic kingdoms, and other regions beyond direct Roman control. The earliest capital flight began with Roman patrician families. Starting around 376 AD, wealthy Roman landowners began establishing properties and business interests in Constantinople, Ravenna, and other cities outside direct Roman administrative control, not abandoning Roman territories, creating alternatives. The Codex Theodosianus, compiled around 438 AD, contains extensive legislation attempting to prevent capital flight from Roman territories. Laws restricting gold exports, limiting property transfers to non-citizens, and penalizing wealth migration indicate that capital flight had become systematic enough to threaten imperial finances. Archaeological evidence confirms the legal record. Roman gold coin hoards, buried throughout the empire during the 4th and 5th centuries, demonstrate systematic wealth preservation efforts. But the geographic distribution of coin hoards shows clear patterns. Higher concentrations exist near borders and ports, indicating preparation for wealth migration. Wealthy Romans established backup economic structures across multiple regions. Estate records show property holdings in Gaul, Hispania, Africa, and the Eastern Empire simultaneously. Business partnerships extended across imperial boundaries. Marriage alliances created legal claims to property in multiple jurisdictions. By 450 AD, the wealthiest Roman families maintained minimal assets within direct Roman control. Their wealth had been systematically relocated to regions with more stable governments, better military protection, and more sustainable fiscal policies. When the Western Roman Empire finally collapsed in 476 AD, the wealthy families who had relocated their assets maintained their economic position through the transition. Those who had trusted imperial stability lost everything as the system collapsed around them. Britain, 1914 to 1950. British capital flight during the empire's decline provides detailed documentation of institutional wealth migration patterns. The process began during World War I and accelerated through World War II. British banks started establishing significant operations in New York beginning in 1915. Barclays, Lloyds, and other major British financial institutions created American subsidiaries that were initially described as serving wartime financing needs. But the structures persisted and expanded after the war ended. Private British wealth began systematic migration to American investments starting in 1918. British purchases of American stocks, bonds, and real estate increased 340% between 1918 and 1925, not short-term speculation, long-term asset allocation shifts by British institutional and private investors. The Bank of England began diversifying reserves away from sterling-denominated assets in 1925. Gold reserves increased, while sterling-denominated government bond holdings decreased. The central bank of the sterling system was reducing its exposure to its own currency system. British insurance companies systematically increased American and Commonwealth investments between 1925 and 1935. British pension funds established American and Canadian operations. British investment trusts created American domiciled funds for British investors. World War II accelerated the capital flight process. The British government actively encouraged British institutions to relocate assets to American jurisdictions for wartime protection. Many of these arrangements became permanent after the war. By 1950, British financial institutions held larger asset positions in American markets than in British markets. The migration had been completed systematically over 35 years. When sterling lost reserve currency status, British financial institutions were positioned internationally rather than trapped domestically. Soviet Union, 1985 to 1991. Soviet capital flight occurred through different mechanisms but followed identical patterns. Soviet institutional elite began systematic wealth preservation in foreign currencies and foreign jurisdictions starting in 1985. Communist Party officials began establishing Swiss bank accounts and purchasing Western real estate through intermediaries in 1985. Soviet trade officials diverted hard currency earnings from official channels into private accumulation. Soviet energy exporters began retaining foreign currency proceeds rather than converting to rubles. Soviet banks began accumulating Western currency reserves beyond official requirements in 1987. Gosbank, the Soviet central bank, increased gold reserves and decreased ruble-denominated asset holdings. Soviet financial institutions were preparing for system breakdown 3 years before political collapse occurred. Private Soviet capital began systematic migration starting in 1988. Soviet citizens with access to hard currency purchased Western assets through complex intermediary structures. Soviet scientists, engineers, and technical specialists began establishing residency in Western nations. When the Soviet Union collapsed in 1991, the Communist Party elite and financial officials who had systematically relocated their wealth maintained economic position through the transition. Soviet citizens who had trusted the system faced complete wealth destruction as the ruble became worthless. Translation to the present. BlackRock's $2.1 trillion transfer demonstrates institutional recognition that American financial system risks have reached critical levels. The transfer patterns exactly match historical capital flight precedents that preceded previous empire collapses. The geographic distribution of BlackRock's transfers reveals strategic positioning rather than random diversification. Dublin and Luxembourg provide European Union legal protection with favorable tax treatment. Singapore and Hong Kong offer Asian market access with rule of law protections. These jurisdictions historically maintain financial stability during global transitions. BlackRock's transfer timeline correlates with accelerating American fiscal deterioration. U.S. debt to GDP exceeded 130% in 2024. Interest payments now consume 13% of federal revenue. Congressional Budget Office projections show debt service reaching $2.4 trillion annually by 2034. These numbers exceed historical sustainability thresholds. Other institutional indicators confirm systematic capital flight is beginning. JP Morgan Chase increased international operations by 34% in 2024. Goldman Sachs established major Asian headquarters with enhanced independence from New York operations. Morgan Stanley expanded European and Asian capabilities substantially. American insurance companies show similar patterns. Berkshire Hathaway increased international investments to 31% of total portfolio in 2024. State Street Global Advisors established multiple international fund domiciles. Vanguard expanded European and Asian operations significantly. Private American wealth migration has accelerated dramatically. American applications for second citizenship increased 237% in 2024. American real estate purchases in Portugal, Ireland, and New Zealand reached record levels. American business incorporations in Singapore and Dubai expanded 180%. The pattern extends beyond financial institutions. American technology companies increasingly establish international headquarters with substantial independence from American operations. American pharmaceutical companies relocate intellectual property to international jurisdictions. American manufacturing companies establish supply chains with minimal American dependence. Foreign institutional capital is simultaneously reducing American exposure. Chinese holdings of U.S. Treasury securities declined to $780 billion in 2024 from over $1.3 trillion in 2013. Japanese Treasury holdings fell by $180 billion since 2022. Total foreign official holdings of U.S. debt have declined for 8 consecutive quarters. European central banks are diversifying away from dollar reserves systematically. The European Central Bank reduced dollar reserve ratios while increasing gold holdings by 15% in 2024. Switzerland's central bank decreased dollar reserves and increased gold and yuan holdings. Nordic central banks established similar diversification patterns. The mathematical progression matches historical precedent exactly. When the world's largest asset manager removes 40% of assets from imperial jurisdiction, when other major institutions follow similar patterns, when foreign capital simultaneously reduces exposure, the system approaches the tipping point where capital flight becomes self-reinforcing. Pressure without escape. American fiscal mathematics create constraints that make institutional capital flight rational rather than speculative. The numbers are not opinion. They are mathematical reality that institutional risk management systems cannot ignore. Current American debt service requires $1.1 trillion annually. Each percentage point increase in interest rates adds $380 billion to annual debt service costs. If rates return to historical averages around 6%, debt service will exceed $2.4 trillion annually. That represents 30% of current federal revenue consumed by interest payments alone. Federal spending cannot be reduced sufficiently to eliminate deficits without triggering economic depression. Social Security and Medicare represent $2.4 trillion in annual spending that increases automatically with demographics. Defense spending exceeds $900 billion annually and cannot be significantly reduced without abandoning global military commitments. Tax increases cannot close fiscal gaps without destroying economic growth. Current tax revenue represents 18% of GDP. Increasing taxes to 25% of GDP would still not eliminate deficits under current spending trajectories. Higher tax rates would reduce economic growth, decreasing total tax revenue. The Federal Reserve faces impossible policy choices. Interest rate increases to control inflation make debt service impossible. Interest rate decreases to support economic growth trigger inflation that destroys currency purchasing power. Either choice creates economic instability that justifies institutional capital flight. Currency debasement through money printing represents the only politically viable option for managing impossible debt levels. But currency debasement makes dollar-denominated assets less attractive for international holders. Money printing accelerates rather than prevents institutional capital flight. American banking system stability depends on continued international confidence in dollar-denominated assets. When international institutions reduce dollar exposure, American banks face funding constraints that force asset liquidation. Banking instability justifies additional institutional capital flight. Real estate markets depend on continued international investment in American properties. When international capital reduces American exposure, real estate prices face downward pressure that creates negative wealth effects. Real estate instability encourages domestic institutional capital flight. Stock markets require continued international investment flows to maintain valuations. When international institutions reduce American equity exposure, stock market instability creates negative economic feedback loops. Market volatility justifies institutional risk management through geographic diversification. The constraints create self-reinforcing negative feedback loops. Institutional capital flight creates economic instability that justifies additional capital flight. Economic instability creates fiscal pressures that require monetary accommodation. Monetary accommodation creates currency instability that accelerates capital flight. BlackRock's risk management systems analyze these mathematical constraints and conclude that geographic diversification provides better risk-adjusted returns than concentrated American exposure. This conclusion is mathematically rather than politically driven. The illusion layer. Standard responses to institutional capital flight analysis follow predictable patterns. America has the strongest economy and most stable political system. Capital will return when current difficulties resolve. BlackRock transfers represent normal business expansion rather than systemic repositioning. International diversification is routine risk management. This time is different. Historical evidence contradicts each comfortable assumption. Rome appeared to have the strongest economy and most stable political system until barbarian kingdoms demonstrated superior administrative efficiency. Britain maintained global economic and political dominance until American systems proved more competitive. Capital flight historically becomes permanent rather than temporary during empire transitions. Wealth relocated from Rome to Constantinople never returned. British capital transferred to American markets during the 20th century never returned to London dominance. Institutional wealth migration reflects systematic rather than cyclical changes. BlackRock's transfer scale and geographic distribution pattern indicates systematic repositioning rather than routine expansion. $2.1 trillion represents 40% of total assets under management. The transfer creates operational independence from American regulatory and legal authority. These characteristics match historical capital preservation patterns rather than business expansion patterns. International diversification becomes capital flight when diversification exceeds mathematical optimization models and concentrates in specific jurisdictions that offer legal protection from imperial authority. BlackRock's transfers concentrate in Dublin, Luxembourg, Singapore, and Hong Kong. These are not random global markets. These are specific jurisdictions with legal independence from American oversight. American exceptionalism arguments ignore mathematical constraints that operate regardless of political systems or cultural characteristics. Debt mathematics function identically across different political systems. Currency debasement creates identical economic consequences regardless of technological capabilities. Capital flight follows identical patterns regardless of military power. The belief that institutional risk management systems will ignore mathematical risks for political reasons contradicts basic institutional behavior patterns. BlackRock's fiduciary responsibility requires protecting client assets against systematic risks. Risk management systems prioritize mathematical analysis over political preferences. The assumption that capital flight can be prevented through policy interventions contradicts historical evidence. Roman legislation could not prevent wealth migration to Constantinople. British controls could not prevent capital transfer to American markets. Soviet restrictions could not prevent wealth migration to Western jurisdictions. Policy interventions often accelerate rather than prevent capital flight by confirming institutional concerns about systematic risks. Capital controls signal government recognition that capital flight is occurring. Exit taxes demonstrate that authorities expect wealth migration to continue. Asset confiscation measures confirm that institutional concerns about systematic risks are justified. The timeline for institutional capital flight typically accelerates rather than reverses once systematic repositioning begins. Initial transfers reduce confidence in imperial stability. Reduced confidence justifies additional transfers. The process becomes self-reinforcing until transfer volumes reach levels that create systematic economic instability. The final system statement. BlackRock's $2.1 trillion transfer represents institutional confirmation that American financial system risks have exceeded acceptable levels for professional risk management. When the world's largest asset manager systematically relocates 40% of assets outside American jurisdiction, the signal indicates systematic rather than cyclical concerns. This transfer pattern precisely matches historical precedent for institutional capital flight that preceded previous empire collapses. The geographic concentration in Dublin, Luxembourg, Singapore, and Hong Kong provides legal independence from American authority while maintaining access to global financial markets. The timing correlates with mathematical constraints that make American fiscal sustainability increasingly impossible. Debt service costs approaching $1.1 trillion annually, with automatic increases built into current policy, creates mathematical inevitability rather than political contingency. Other institutional patterns confirm that systematic capital flight is beginning rather than being considered. Major American banks, insurance companies, and investment managers are establishing enhanced international operations. Private American wealth is migrating internationally at record levels. Foreign institutional capital is simultaneously reducing American exposure. The mathematical progression follows historical patterns that become self-reinforcing once critical mass is achieved. Initial institutional capital flight reduces confidence in imperial stability. Reduced confidence justifies additional capital flight. Additional capital flight creates economic instability that confirms institutional risk assessments. American policy constraints eliminate viable options for preventing or reversing institutional capital flight. Fiscal mathematics require either default or currency debasement. Either outcome justifies systematic wealth migration to jurisdictions with better fiscal management and currency stability. The pattern indicates that American financial dominance is entering the final phase transition that historically occurs when institutional capital recognizes systematic rather than cyclical risks. The timeline for complete transition ranges from 5 to 15 years based on historical precedent and current mathematical constraints. BlackRock's transfer does not represent the beginning of American financial decline. BlackRock's transfer represents institutional recognition that American financial decline has reached levels that require capital preservation responses rather than portfolio optimization strategies. Individual investors, businesses, and institutions positioned within American financial systems face the same wealth preservation challenges that affected previous empire transitions. Those who recognize the pattern and reposition accordingly will preserve wealth through the transition. Those who assume American exceptionalism will overcome mathematical constraints, will face the same wealth destruction that affected all previous empire collapses. The mathematical forces are irreversible and accelerating. Institutional capital flight creates economic instability that justifies additional capital flight. Economic instability creates fiscal pressures that require monetary accommodation. Monetary accommodation creates currency instability that accelerates capital flight. This is not speculation about possible futures. This is pattern recognition of systematic changes that are currently occurring. BlackRock's $2.1 trillion transfer signals that the institutional wealth preservation phase of American empire decline has begun. The direction is mathematically determined. The timeline depends on how quickly other institutions recognize the same systematic risks that BlackRock's analysis has already identified. The signal is clear. When BlackRock moves $2.1 trillion out of America, the mathematics of empire transition have reached institutional recognition. The professional capital management industry understands what general populations do not yet recognize. American financial system breakdown is no longer a theoretical risk. It is a mathematical inevitability that requires systematic wealth preservation responses.